Hello everyone and welcome. My name's Elliot Gu. I'm co-founder and chief analyst for Deep Dive Investing, and welcome back to the Deep Dive Investing YouTube channel. Today I'm actually going to cover a topic that's very popular with our readers, and it relates to a question I get an awful lot. And it's actually about a group of securities called Master Limited Partnerships, or MLPs. They're a group of high yield securities. The average yield on an MLP right now is north of 7%. Which is particularly attractive in an environment where the Fed's now cutting interest rates and interest rates are generally falling, certainly many times what you can get off most income-paying stocks out there. MLPs also pay tax-advantaged distributions. The income you receive from an MLP is actually reported on a K-1 form come tax time, and this actually allows you to defer taxation on a significant portion of your income every year from MLPs. Most MLPs out there are involved in the energy business, but they're involved in the midstream energy business. So the midstream energy business is not the production of oil or natural gas. It's actually the transportation and storage of energy-related commodities, some processing as well. So assets that these companies would own would include things like pipelines, oil and natural gas pipelines, gasoline pipelines, diesel pipelines, etc. Also, you might have storage terminals for oil, natural gas processing plants, natural gas pipelines, assets of that nature, the midstream energy business. Investors have traditionally valued the group for its income, obviously, as I said, much higher yield than most securities out there right now, but also its defensive characteristics. Now, as many of you know, energy has been a tough place to be so far in 2019. The S&P Energy Index is up about 7%. Which is a small fraction of what the overall market is up. Energy has been all over the place. We've seen oil trading up over $70 a barrel at one point late last year, under $50 a barrel, down in the low 40s a barrel towards the end of 2018. It's been kind of bouncing around. So energy has been a tough place. But MLPs have sort of regained their defensive characteristics this year. So we've actually seen the Alerian MLP index, which is a popular benchmark for these securities. It's actually up almost 15% year-to-date in 2019, which is beating the S&P 500 Energy Index by a margin of more than 2-1. So what I want to talk about today, though, is not how MLPs have performed, but now that a lot of investors are getting really interested in this group again, we're seeing a lot of opportunities to buy MLPs, a lot of opportunities in this group right now. I want to get back to one of the most common questions, misconceptions, things that are out there about MLPs that I don't think is properly understood, and I want to kind of shed some light on it. And it relates to this concept called incentive distribution rights, or IDRs, incentive distribution rights. Now, there's been a lot of talk about IDRs in recent years, partly because we've seen a number of MLPs either convert from a partnership, an MLP, into a normal corporation, or what's even more common is what's come to be called simplification transactions. And basically what that involves is the master limited partnership changing its structure to eliminate these incentive distribution rights. So there's a lot of interest in this. One common question that I often receive is, will such and such an MLP be the next to convert to our corporation? Or this MLP is simplifying, it's doing a simplification transaction. Is this a good deal for me as a unit holder or not? So I want to explain in this video, this is going to be a two-parter, I want to explain to you exactly what IDRs are, how they're calculated, how they affect MLP's ability to grow, and how they affect MLP's cost of capital. Then I also want to do this by taking a specific look at a real-world MLP. In this case, we're going to take a look at an MLP called Phillips 66 Partners. The symbol there is PSXP. I'm going to show you exactly where you get all the information you need to know to calculate these IDRs. And Phillips 66 Partners actually recently announced they are going through a simplification transaction. So as a result, I want to take a look at that specific transaction and explain to you why I think it's a good deal or not. So we're going to be covering a lot of ground in this video. That's why I've broken it up into two parts. In this first part, I'm going to go through the basics of IDRs, how they're calculated, what they mean, why they have such an important, crucial impact on an MLP's ability to grow and its cost of capital. And in part 2, we'll look specifically at that PSXP deal and what it means for you as investors if you're a shareholder in this MLP. Okay, so historically, master limited partnerships are actually the combination of two entities. You have a limited partner, or LP, and a general partner, or GP. So an MLP is really two different entities. When you buy an MLP, when you go out there and buy an MLP like PSXP, if you went out and bought that, you would find that you're actually becoming a unit holder, the MLP equivalent of a shareholder, in the limited partner, not the general partner, the limited partner. As an LP unit holder, you receive quarterly distributions from the partnership's assets, so the money generated from the pipelines and storage terminals and all the assets the MLP owns, you're going to receive distributions from those cash flows. You're entitled to that as an LP unit holder. But you don't actually manage the assets of the MLP itself. That's actually a function performed by the general partner for the master limited partnership. So the general partner is the company that's actually managing the assets, making decisions on contracts and things of that nature. The general partner can be a publicly traded company. In the case of Phillips 66 Partners, it is a publicly traded company. The ultimate parent of the general partner is Phillips 66. Symbol there is PSX. So that's a publicly traded company, but in many cases it's not a publicly traded company. The general partner is a private company or even a private equity firm. It can really be anyone. In most cases, the general partner does own LP units. So in addition to being the general partner, the company that controls that general partner often actually owns units, owns shares, if you will, the MLP equivalent of shares in the limited partner as well. But in addition to that, they're usually entitled to something called incentive distribution rights, as I mentioned, IDRs. Now the IDRs they're kind of like a management fee paid by the LP, by the MLP to the general partner. So they are a fee paid every single quarter. Typically they're paid out according to a specific schedule, which is laid out in the offering documents for the MLP when it first goes public. And as I'll show you in a minute, you can also find the structure, the schedule for IDRs in the 10K or annual report published by the MLP, published by every public company at the beginning of every year. In this case, PSXP's K1, or rather 10K, which I'll show you in a minute, was actually published back in February. So IDRs are typically paid out according to a tier structure, and those different tiers of IDRs are based on the distributions paid to you and me as LP unit holders. So when you buy an MLP, it pays out a certain amount per unit that you own every quarter, just like a dividend, but it's a distribution. And then the IDRs paid to the general partner are based on that. So the higher the distribution to LP unit holders, the larger the percentage paid out to the holders of the IDRs, or incentive distribution rights. So if you think about that, the idea behind an IDR is that it encourages the general partner to manage the MLP's assets in such a way that it can boost distributions to you and me. So in other words, if the general partner manages those pipelines properly, makes good decisions on new projects or acquisitions, grows cash flows, and therefore can increase its payout to limited partner unit holders, then they get a bigger share of the pie, if you will. And I'll show you exactly how this works in just a minute. So it's kind of an incentive, hence the term, for the GP to grow distributions for LP unit holders. As I said, it's a preset tier structure. It's actually laid out in the offering documents and in the 10K. And as I said, the idea is to incentivize the GP to make decisions that boost LP unit holders' distributions. Now, it's very important to note, and this is a very common misconception, when an MLP declares a distribution to you, let's say the MLP comes out and says, I'm going to pay you out 85 cents this quarter, you receive the entire 85-cent distribution. That amount they declare is the total amount paid out to LP unit holders like you and me. That's what you receive. The IDRs are paid in addition to that. So they're paid out of the MLP's cash flows, the same pot of cash flows, but they are in addition to that declared distribution that you get every quarter. So they're an additional fee paid by the MLP, in this case, to the general partner. So it's not a deduction from your distribution, very important. It is in addition to that. And again, I'm going to show you in just a second exactly how they're calculated. Now, the important thing is that because it's an additional cash payment, that money has still got to come from somewhere, and it's coming out of the cash flows of the MLP. So if those IDRs get very large, it can really affect an MLP's ability to grow. It means that they have to generate more cash flow growth just to generate a relatively small increase in distributions for you and me as LP unit holders. It can also have a profound effect, particularly in recent years, on an MLP's cost of capital. In other words, how much they have to pay to borrow money, either through debt, issuing bonds, or more importantly, by issuing units in terms of what they have to pay in terms of distributions. So it can affect their cost of capital and their ability to grow in a very profound way. Frankly, it can be a good thing or a bad thing. And I'm going to show you exactly what I mean by that and how we calculate it again. So the best way to explain is actually, I think, to just go through an example. It all sounds great in theory, but let's look at an exact example of how these IDRs are calculated. And again, I'm going to be using Phillips 66 Partners, which is an MLP trading under the symbol PSXP. Their general partner is publicly traded Phillips 66. And the point here is that this company, this MLP, is actually going through a simplification transaction. So today, I'm going to show you in this short part one of this video how the IDRs are calculated, why they've been raising Phillips 66 Partners' cost of capital in recent years, and then in part two of this video, which I'll release here in a couple of days, I'm going to explain the simplification transaction that Phillips 66 Partners has just proposed, what it means for unit holders, and whether I think it's a good deal or a bad deal. So let's go ahead and get started.
So what I do first is I go to the SEC's website, sec.gov. Now, that's the easiest place to find this information I've found, and really all I'm going to do is I'm going to find the most recent 10K for the MLP that I'm analyzing. Now, the tier structure of IDRs, as I mentioned, is actually set out in the offering documents before the MLP even goes public. But the easiest place to find it is actually just to look at the most recent annual report or 10K filing with the SEC. So you go to the SEC's website, which is here, sec.gov. Click up here on the top right where it says Company Filings. Go to where it says Fast Search and type in the ticker symbol for the MLP. In this case, it's PSXP for Phillips 66 Partners. You click Search. Scroll down in the filings until you see the most recent 10K. In this case, it's the 10K, the annual report that was filed on February 22nd of 2019, this year. Click where it says Documents, then click where it says 10K, and that'll pull up the whole 10K filing for you. Then what I generally do is I just hit Control F and I type in incentive distribution rights on the box that appears. And what that allows you to do is just search the filing for that term. You're going to find a lot of hits, in this case 17 hits, but what you're really looking for is a very specific table in the report. So if you just kind of scroll through all these hits of incentive distribution right, eventually you'll come to a table, here it is, that looks just like this. And what this table is it's actually telling you the tier structure for Phillips 66 Partners. In this case, we have a minimum quarterly distribution of 21.25 cents. And then we have a first target distribution between 21.25 cents and 24.4375 cents, and so on and so forth until we get to the final tier of the distribution, the high splits it's called, which is the part of the distribution that's above 31.875 cents per unit. Now these tiers are based on the quarterly distribution per unit paid to LP unit holders. So that's you and me. It's based on the amount we're paid out every quarter. Now, as I'll show you here in just a minute, in this case, Phillips 66 Partners is actually paying out a quarterly distribution of more than 85 cents per unit, which means that it's well into the high splits. Because the way it works is the first 21.25 cents of that 85 cent distribution is taxed, if you will, in this way. 98% of it goes to LP unit holders, 2% goes to the general partner, and so on and so forth. Now I'm going to show you exactly how that's calculated here in just a minute, but you can see the tier structure is right here, and that's how you find it.
Okay, so now we have the tier structure for Phillips 66 Partners, which I just pulled off that 10K right up on the SEC's website. You can do the same basic procedure for any MLP you might own or be interested in. So now that we have the MLP's tier structure, what I want to do is just go through the calculations of the different tiers of incentive distribution rights. So we know that PSXP, Phillips 66 Partners, paid out an 85.5 cent distribution in the most recent quarter. That's what they declared. So let's run that 85.5 cent distribution per unit through the IDR tier structure. So let's start with the minimum quarterly distribution. So the minimum quarterly distribution tier, as I showed you, is 21.25 cents. So the first 21.25 cents of that 85.5 cent distribution, that first tier of the distribution, that 21.25 cents actually represents 98% of the total amount paid. Now, there's the LP distribution and the IDRs, and the LP distribution plus the IDRs equals the total amount paid out, okay? So we know what the LP distribution is in that first tier. It's 21.25 cents. So what we need to know is what the IDR payout would be at that tier. So to calculate that, all we have to do is take that 21.25 cents and divide by 0.98. That gives us 21.684 cents per unit. And we take 21.684, subtract the amount that's paid to LP unit holders, and the difference there, which is a little over 0.4 cents, literally, is the amount paid to IDRs to the general partner. So you can see in that first tier of the distribution structure, the LP is getting vastly more cash flow than the GP. The GP is really not getting much at all in terms of an IDR per unit. So let's move to the first tier. Now the first tier is actually the structure is very similar. It is the amount of that 85.5 cent distribution that is between 21.25 cents and 24.4375 cents. So that's a total of about 3.2 cents, as you can see here, 3.188 cents. And that 3.188 cents represents 98% of the total distribution. Again, total distribution, LP distribution, IDRs equals total distribution. So we take that 31.88 cents, divide by 0.98, and we come up with the total distribution at this tier of 3.253 cents. We subtract the amount paid to LP unit holders from that, and we come up with actually very, very little paid out to the GP at this tier. It's only a very small tier. So let's keep going. Tier 2, this is the amount between 24.4375 cents and 26.5625 cents. So this represents a little over 2 cents of distribution paid out to the LP unit holder, a little over 2 cents of that total 85.5 cents. But at this tier 2, once you get up to above 24.4375 cents, this represents, the amount paid to LP unit holders only represents 85% of the total distribution. Same formula, we take that 2.125 cents, divide by 0.85 at this tier, and we come up with 2.5 cents. We subtract the 2.125 cents from the 2.5 cents, and we come up with that small amount there, going a little over a third of a cent, going up to the GP at that tier. And so we keep going through every tier in this manner. And finally, of course, we get up to the high splits tier.
Okay, so I don't want to get too tedious with this, going through every tier of this thing's structure, IDR structure. So I want to show you how I actually do it. I create a spreadsheet for all the MLPs I cover that do pay IDRs to kind of calculate over time what kind of an effect these IDRs are having on their cash flows. So this is my little spreadsheet for Phillips 66 Partners. Not the neatest thing I ever put together, but it works for me. So you can see here the name of the MLP, Phillips 66 Partners, the symbol, the current quarterly distribution, 85.5 cents. This is the total number of units outstanding. So there are about 125 million shares or units of this MLP outstanding. And you can see here, I just took the tier structure and input it into the spreadsheet here in the middle. Okay. So you can see the different levels of IDRs, the 98% tier to the LP unit holders, 85, 75, and then finally the high splits here above 31.875 cents per unit, which I showed you earlier. And so what you can see here is I went through the same exact calculation I just showed you for each of these tiers. So you can see that first tier, there's your 0.434 cents, the total distribution here, and so on and so forth. But what you can really see here is that virtually all of the IDRs paid to the general partner for Phillips 66 are a result of the amount of the quarterly distribution of 85.5 cents that is above that high splits threshold of 31.875 cents. So the IDRs are tiny all the way up through tier 3. When we hit tier 4, suddenly we're 53.625 cents above that threshold there at 85.5 cents, and the IDRs being paid are 53.625 cents per unit. So you can see how that is really the thing. When you get up to this tier, that is where you are really you're really starting to see a big impact on the IDRs paid when you get that distribution above that 31.875 cents. So let's just look at the whole totals there. As an LP unit holder, you are paid that 85.5 cents here. The GP is paid 56.27 cents in total, adding up all those tiers. Again, most of it's that high splits tier. So the total distribution paid by the MLP every quarter is actually 1.4177 cents. So you think, okay, well, they're paying out 85.5 cents to unit holders as a distribution, and that's true, they are. But on top of that, they're paying out another 56.3 cents in IDRs. The total amounts there, the distributions paid to LP units is just that multiplied by that, the total number of units multiplied by the payout per unit. That's about $107 million a quarter in the most recent quarter. But the IDRs, look at that, 70 million bucks paid out in IDRs to PSXP GP because of this IDR structure. So the total amount paid out overall is actually $177 million in a quarter because those IDRs are adding so much to the total call on the MLP's cash flow. So let me show you how this has changed over time right now.
Okay, so that's it in a nutshell. I showed you where you could find the IDR tiers for an MLP. I showed you how we calculate the total distribution and the IDR share at each level of the IDR tier. I showed you a spreadsheet detailing exactly how much is paid in total out by PSXP, this particular MLP, in the most recent quarter, and how much of that was paid to LP unit holders, how much of that was paid in IDRs to GP unit holders. Now PSXP, and now I want to show you what effect this can have on the cost of capital for this MLP over time. So what I'm going to do is I'm going to throw up a chart here in just a second. But first I want to say, PSXP went public back in 2013. Now as you can imagine, the distribution paid out started out very small, basically right in line with that minimum quarterly distribution. And then over time, they've boosted that distribution consistently over time. So as time goes on, they've moved through the tiers. So they move from the minimum quarterly distribution into tier 1, and then tier 2, and then tier 3, and then they moved into the high splits. And then every quarter since they moved into the high splits, they've moved deeper and deeper and deeper and deeper into those high splits. Now, the farther you get above that high split threshold, the more of the income paid out represents only 50% of the total payout. So in other words, they need twice as much. In other words, if they grow 5 cents over the high splits threshold, they're actually paying out 10 cents, right? Because they have to pay out 50% to the GP and 50% to the LP. So they need to actually grow 10 cents to grow the LP distribution by 5 cents. So this becomes a bigger and bigger tax, if you will, on the growth of the MLP. That the higher the LP distributions go, and the higher we go above that high split level. So let's look at the exact history I calculated for this MLP going back to 2013. Okay, so let me explain this chart for you. This chart actually consists of two items. The orange line, which is on the left-hand scale on the chart, actually shows you the millions of dollars and millions of dollars what's paid out to Phillips 66 general partner every quarter in incentive distribution rights. Those blue bars, which are tracked to the right-hand scale, which is also in blue, is actually the percentage of the total payout by the MLP that goes to IDRs. So in other words, we have the total payout, as I explained, the LP distribution plus the IDRs equals total payout. So what percentage of that total payout number is actually paid to the GP rather than you and me as LP unit holders? So what you can see is these numbers have changed dramatically over the years. Back in 2013, 2014, when the MLP was very young, in its first year of being a public company, they paid out very, very little in actual IDRs. It was maybe a couple $1 million at most by the end of 2014 in terms of incentive distribution rights. And it represented only around 5 or 6% of the total payout every quarter. So really not that meaningful at all in terms of affecting the cost of capital or growth for the MLP as a whole. But what you can see is it very quickly changed. So by the end of 2015, they were paying out around $11 or $12 million every quarter in incentive distribution rights to the general partner. And by that point, by the end of 2015, it already represented just under a quarter of the total payout every quarter. But then look what happened between the end of 2015 and the end of 2017 over, say, a 2-year period. If I jump over there, you can see that they were already paying out sort of 37% of the total payout was going to the GP. And by the end of 2017, it was getting pretty close to $50 million a quarter, $46 or $47 million a quarter. So over time, it starts out small, but over time, as PSXP raised its distribution more and more, went deeper and deeper into those high splits, these incentive distribution rights became a much more meaningful sum in terms of absolute millions of dollars every quarter, and also a much more meaningful part of the overall company's cash flows, the total payout paid every quarter. So let's look at exactly how this acts as a sort of a tax on growth and increases the MLP's cost of capital over time. So if we look at the Q2 2019 LP payout, the total amount paid out to the LP unit holders was $106.82 million. Let's call it $107 million. The total GP payout, the total IDRs paid, was a little over $70 million. So the total was around $177.1 million in the second quarter of this year. Now the total distributable cash flow generated by the MLP, basically a measure of the total amount of cash that they had available for distribution to meet these payouts, both to the LP and the IDRs, was $254 million. So it is good news that $254 million is more than $177 million, so they covered their distribution adequately. In fact, the coverage was about 1.44 times. In the MLP industry, there's a wide range of distribution coverage. Some low-risk MLPs, like Phillips 66 Partners, have fairly low-risk assets, fairly good asset base. Oftentimes you'll see coverage of around 1.15 or 1.2 times. 1.44 times is a very healthy coverage ratio. And again, the way I calculated this was just by saying $254 million divided by $177 million is about 1.44 times. But let's do a little hypothetical and say that Phillips 66 Partners wants to increase its quarterly payout by 10.2% over the coming 12 months, over the next year, from the current 88.5 cents a quarter up to about 97.5 cents a quarter. That's about a 10% increase, roughly. But they want to try to keep the coverage ratio constant. So they want to increase their distribution by 10%, but they don't want to cut into the excess capital that they're holding over. So in other words, they have that $254 million, and they want to grow that enough to cover that higher total distribution. So not only the 10% greater distribution to you and me as LP unit holders, but also the additional IDR they would need to pay out to meet their obligations to their general partner. So let's calculate what that would actually mean for cash flows. A total payout for the LP at 97.5 quarterly, right? The total LP payout based on the current share count of around 125 million shares, a little under 125 million shares, is $121.8165 million. Now that's what it would mean if they boosted their distribution by 10% That's the total amount they'd have to pay out in that quarter in millions of dollars. Now, if we run that through the IDR structure, and as I'll show you in a minute, they've proposed a transaction to eliminate these IDRs. But if that weren't happening and we ran it through that IDR structure, what would that mean for the GP's IDRs? What it would mean is that the IDRs would jump all the way from $70 million, a little over $70 million today, all the way up to $85.26 million. So the total payout required to meet that 97.5 cent per quarter distribution to the LP would be $207 million. $207 million in the quarter to meet the total payout to the LP and GP. So it would have to be, the total payout would increase from $177 million all the way up to $207 million every quarter. Now, to retain the current coverage level, they would have to grow that. Currently it's $254 million in distributable cash flow. They would have to grow that cash flow by enough to cover this higher payout and then some. So the distributable cash flow, if you do the math, would actually need to increase to almost $300 million, $298.19 million. That's an increase of 17.5% nearly in distributable cash flow just to generate a 10% increase in the distribution paid to the LP unit holders. So you can see how this would be a problem. In the early days, when the GP isn't taking much, IDRs are still very low. Basically, if the MLP wants to increase its distribution by 10%, they just need to increase their cash flow by roughly 10%, right? But now, as we are deep in the high splits where we are today, in order to generate a 10% increase in their cash flow, they need, in their distributions, they need to generate a more than 17% increase in their cash flow. So they need to generate a lot more growth in their cash flow just to generate a relatively small growth in the distributable cash flow. So I think you can see, or they're just distributions to you and me as LP unit holders. So I think you can see how this is kind of a tax on their ability to grow. It makes it harder for an MLP like PSXP to grow over time. Okay, so I think that's a pretty good explanation of IDRs, what they are, how you calculate them, why they influence an MLP's cost of capital, and specifically why they've influenced PSXP's cost of capital, and how that changes over time. Hopefully that helps demystify this topic, which seems to kind of baffle a lot of people who are new to master limited partnerships. In part 2, I'm going to look specifically at this Phillips 66 simplification transactions. And basically, to give you a little preview, what they're doing is they're issuing shares, additional units of the MLP to the general partner in exchange for eliminating this entire IDR structure. So I want to look at how much they're paying to eliminate the IDRs and whether it's a good or a bad deal for LP unit, and why I think one of the more common ways of evaluating this question, is this good for me or not, is erroneous and just a bad way of doing it. So we're going to get to that in part 2. Hopefully you enjoyed part 1. If you did, hit the like button below the screen. Also consider subscribing to our YouTube channel, Deep Dive Investing. If you subscribe to the YouTube channel and also hit that little notification bell that's below the video there, then it'll alert you the second that I post this part 2 of this video and all future videos we put on the channel. Again, thanks very much for listening to me today. I hope you enjoyed it.